Hey everybody, welcome back to the channel. I'm Doug the Retirement Guy, and today we're breaking down what a lot of you asked for. We got this for a lot of different comments out there, the Charles Schwab ETF Showdown. Who's really better, SCHD or SCHG? You got the Charles Schwab U.S. Dividend Equity versus the Charles Schwab U.S. Large Cap Growth Fund. You want higher yields, dividend focused, income for retirement, quality blue chips. We got SCHD for that. You want growth, lower yield, capital appreciation, tech and large cap growth. Well, which one is actually better for retirement? We're going to cover that today. So before we dig too deep into it, I got to do a shout out, guys. Thank you so much. But this retirement made easy coffee mug, living on dividends, I just got to throw it out there. Thank you so much. We actually have already got our second load in. We've already blown through almost half of our second load already. Um, it's something unique I came up with, and so many of you seem to really appreciate and like it. And thank you for supporting the channel. If you want to get one of these coffee mugs, go down in the description below. You'll see a little link there. It'll take it on to my own personal website that we're working with, and you can click onto it, order your mug. It goes out almost literally same day. Uh, just something to help the channel. And also, all of our Patreon and our YouTube subscribers, thank you so much for being part of everything. Important disclaimer, the content is for educational and entertainment purposes only. It's not financial advice, and the presenter is not a financial advisor. Investing involves risk. Income is never guaranteed. Past performance does not guarantee future results in any way. If you need help, always contact a financial licensed financial professional, as we are not. So this presentation that we're going to do, the overview and the objections that we're really trying to get here is what we're going to explore today is the funds, definitions, and their DNA. Income generation methods, the yield and growth performance, the tax treatment, and the risk profile. What you'll walk away with is knowing which fund fits your income needs, understanding the role in growth in retirement, and see how to use both funds strategically. Build a more balanced retirement portfolio is ultimately the goal that I try to get from these particular funds. Let's talk about Charles Schwab. SCHD. This is Charles Schwab's U.S. Dividend Equity ETF. Now it tracks the Dow Jones U.S. Dividend Income, 100 Index. Expense ratio is 0.06, virtually free. It's $6 per year if you invested $10,000 into a particular fund. The holdings are 100 qualified dividend paying U.S. companies. They're looking for quality. They're not looking for, flash in the pans. They're not looking for the big names. They're looking for high quality that pay dividends long periods of time. The key sectors that they're into right now, healthcare, consumer staples, industries, and financial. Every March, they rebalance their portfolio of what sector's the big sector. You didn't hear technology in this. They don't look at technology as the long-term dividend fund. They're looking at these particular four really big. It's built to give investors dividend income, dividend growth, and a value-oriented quality, not maximum yields. Okay? So remember, this is not a yield play. This is one of these things why I love Charles Schwab so much and the dividend side of it. I personally own this because I don't chase yield. This thing pays off slowly. It's the turtle in the race. They have a high quality screen of companies that select the financial strength and the dividend history that they're looking for. They're looking for dividend growth focus, not the highest yields, but built to sustainable growth income. And total return potential, income plus moderate capital appreciation wins over time. Almost exactly how I invest my entire career. So let's take a look at what they have. $95 billion in net assets. So it's well above any of my warning signals. It paid $1.06 in the past 12 months or 3.28%. Now that is going to tell you right now, that's a different story coming into that number. Pays out quarterly. Now this fund came out in 2011, so we're getting close to 15 years old. But look at the dollar amounts. It's $32.92 for a 52-week high. And it's bouncing right around that mark between $31 to $32. Okay? It's bouncing in that market high. It's had a 20% growth already this year alone. So what they've done is they've rebalanced themselves last March, and it made a huge change in the fund as they finally made the right decisions. Look at the performance over time. This is one thing I also learned about is what happens not only in 1 year, but 5 years, 10 years. How far out can I go? Well, since inception, this thing has had a 13.12% total return. 12.78 over 10 years, 8.82 over 5. In the past 12 months was 24.97% total return. That means you're getting growth with income across the board. Now let's turn to the Charles Schwab U.S. Large Cap Growth ETF. Now this one here, again, tracks the Dow Jones, but it uses the Large Cap Growth Total Stock Market Index. Expense ratio 0.04, which means $4 for every $10,000 invested. Now it holds about 250 large cap U.S. growth companies. And what they look for is the build capital appreciation, not income. This is why I always call these two brother sister. One's income, one's for growth. It holds key holdings like Nvidia, Apple, Microsoft, Amazon. This is the technology side of it. It's the technology and innovation companies that they're looking for that big, massive growth. It also has the consumer discretionary and communication services. So totally almost opposite of what you just saw from its twin of SCHD. When we look under the hood of this one, $58 billion in assets. So they have tons of money tied into this. Now the dividends, 13 cents. So it's a 0.38. Like I said, this is not an income generating fund. Now this fund really has been out there almost 16 years already. Pays out quarterly. But the pricing that they use on this stuff, because this one just had a split in 2026, it keeps the price in line for most retail investors. $35.42 as a high for 52 weeks. The range right now, 32 to 33. So the performance of this fund going all the way out as far as we can, since inception, a 16.12% average total return. Now because the yield is so low, that means majority of that is growth. So it's 16% almost per year. 18% at 10-year average, 13% at 5-year, and this last year was 15.82%. So the fund has had some very, very strong growth, even with the NASDAQ 100 having good strong growth. This one's done it time and time and time again, in good times and in bad. Now the natural income generation from Charles Schwab SCHD. Today it's 3.25%, trailing 12 months. Now I know a lot of you are sitting out there saying, well, if I want income, I can't live on 3%. That's hardly inflation. There's a story behind that. So if you put $100,000 invested today into that fund, you'd be collecting basically $3,250. Quality company, earns profits, pays dividends, and Charles Schwab distributes that to you. It's virtually how the whole program really settles into. But what are the real numbers of that 3.25%? Well, what you miss of this is the growth of the dividends and the growth of the companies. The bigger the companies grow, the more dividends they pay out, the percentages come through. And this is why I always say yield is always a falsehood in what's really going on under the hood. You got to do some research. So the results after 10 years, if you took your portfolio, and we started that with a $10,000 type application, you invested $10,000 into it. You reinvested your dividends. Didn't take your money out. You just kept reinvesting it. Your portfolio would be worth $23,104 or 131% increase. The annual dividend income would be up to $1,075 a year. That means you'd have $89.61 in dividend income each and every month from that $10,000 you originally invested, which puts it at 10.75% off of your cost on yield. Now, if you're a person like myself that's living off of income, so you're not going to reinvest your dividends, the same story almost works. That $10,000 today, after 10 years, would be worth $16,289, or up 62.9%. Annual dividend income, $758 a year. Your monthly, $63, for a 7.58% dividend. Now, this is what I use, and said this many times. I own this fund, and I put money into it years ago, and I just let it sit. And yes, I was always the guy sitting there saying, oh my God, 3%, this ain't worth it, this ain't worth it. And then I started doing my research and finding out, wow, my 3.25 actually grew to a 7%, 7.5% yield. So what's happened is the longer you let this set, the better and better it gets. Okay, it's like aged wine. It gets better and better. Now, if you're before getting into retirement, before you're out there, you've got 10 years out, this is a fund you could easily be funding right now and have a fund dialed in that would be collecting your 10% 10 years from now. Now, these are past numbers. Remember, past performance does not guarantee future results, but this is history. This is exact numbers directly from Charles Schwab and the calculator that we use. So that 3.25 does throw a lot of people off. Now, creating income with SCHD is not going to happen. You got to make sure you have the right person in the right seat on the bus. I'm not saying SCHD is a bad fund, but if you're trying to put it into income, 0.36% trailing yield is not going to buy you a cup of coffee. Okay? It's not a lot of money. Like I said, $100,000 into it roughly gets you $360 in dividend yield. Yeah, I call that's coffee money. That's all it is. That's not going to pay your mortgage. It's not going to pay your rent. It's not going to pay anything. To generate income, you got to own SCHG shares. You have to sell shares periodically to receive cash proceeds to help things along. This is not one of those things that I highly suggest you put into an income fund. So when you do a head-to-head comparison, your 3.28% to a 0.37%, guys, night and day difference. Charles Schwab's SCHD is built for income. That's 9 times different. So what is SCHG actually for? Growth. Here's the difference. Look at these two funds. Charles Schwab, and I know they're both Charles Schwab. I'm sorry. I keep doing this. SCHD, 12.8% 10-year annualized return. That's their average. SCHG, 18.94%. You see how if you put both of them get on the bus. They're both great companies. They're both great funds. You get them on the bus. If you put them in the wrong seats, you're going to have a bumpy ride. You put them in the right seats, you're going to have some spectacular field days with this. $10,000 into Charles Schwab for over 10 years. You got solid growth with dividend income included. That same $10,000 in that same 10 years, you have a huge fund, $57,000. That's 76% more wealth created than SCHD. So if you are a person who does not need the income right now, this is where you want to be parking your money. Grow, 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 baby. Okay, and this is why I would put this into a growth fund across the board. When we take a look at the total return analysis year to date, well, of course, the winner is going to be SCHD at 19.48% because of the income that is already starting to generate. But when you take a look at the 3-year, the 5-year, the 10-year, look at the numbers. We got 10 percentage points difference. And then you get into really about a 6% over 5-year and 6% over 10-year. Those add up to some big, big numbers. So year to date, SCHG, yeah, it's struggling a little bit on that year to date total return, but everything else, it crushes it. So SCHG leads the short-term cycles, but long-term compounding, SCHG has it. They both have a place in a portfolio. Now, tax treatments, well, the higher distributions and the tax shelter accounts, you want to put this in a 401k or an IRA. If you're doing a brokerage fund, you really don't have much in that tax protection, I call it. It pays higher dividends, more taxable income each year in taxable accounts. Dividends are maybe qualified or low qualified dividend tax rate, depending on how long you hold it. And its best position, like I said, is in the IRA or a 401k. Now, SCHD is a lower distribution rate. So if taxable accounts, you pay very little dividend. Minimal annual tax drag in the taxable brokerage account. Mainly tax of when you sell your shares and realize the capital gain. But if you've done that for long term, you're going to have long-term capital gain, which can be really from 0 to 15%. So it gives you more control and more timing of when you take those funds. So it's got a little more tax efficiency with that long-term investors for building wealth outside of retirement accounts. So this one here, I have no problem with being in a brokerage account or either a 401k or an IRA as well. So it's the best of all worlds. So remember I talk about when I have my 3-bucket retirement portfolio system? I just explained this in a great video out there of how we have a foundation bucket, a growth bucket, and an income bucket. And this is what I always call my bus ride. If you put the right funds into a portfolio and then you put them in the right seat or the right bucket, you can sit back and enjoy life and not have to worry about a single thing. It's simple, it's balanced, it's built for life. This is my bucket system I use that I can really much retire, and I made it easy, and I live on my dividends. Yeah, I know, I'm repeating on what's on the cup. So the winner of a retirement income is SCHD. You know, that 3.25% dividend, about 9 times bigger than SCHG. It's a natural cash flow, no shares to sell required. You just take the dividends, they arrive automatically every quarter. You can supplement your income, pairs well with Social Security pensions and other income sources. But 10 years down the road, 7.58, so you want to start as early as you possibly can. This is not something I would always say jump into right now today if you're into retirement, unless you got a lot of money you want to pack away into it. But if you're 10 years out, boy, I'll tell you what, I would start talking right now about possibly investing into this fund. This one gives you longer, the earlier you get into it, the bigger it will get. The winner of retirement growth, SCHG. So you can see where both of these funds really work well, but look what you got. 18.94% over a 10-year annualized return. $57,336 from a $10,000 investment 10 years ago. Again, another fund that grows across the board. It's a stronger compounder. It's working in the tech and innovation areas, has a very low tax drag, and it's an inflation fighter. So you want to make sure you're putting these in the right buckets. This is a growth bucket. CHD is the income bucket. So your risk and your volatility comparisons. SCHD is a defensive quality focus. It's valued on dividend-oriented stocks. It holds established companies with strong balance sheets. They're doing the research for you. They're checking everything out. They're telling you what's good, bad, and ugly. They're getting their fingers dirty underneath the hood. This is an income and defensive sector led, outperforming the investors that seek stability, quality, and yield over momentum. While the SCHD is for growth, innovative companies, high-tech companies, high expectation companies that reinvest cash into expansion, growth of stocks that are led the marketplace. It's going to have some higher volatility to it. There's going to be a little bit more risk to it. But down the road, the risk reward wins in the growth side. So the strategic roles in a portfolio, as I said earlier, income bucket is SCHD. SCHG is in your growth bucket. That way it's growing, covering inflation, fixing you down the road while you're living off the income that you get from SCHD. One pays you, one grows you, together gives you a balanced retirement across the board. So my final verdict and the bottom line of all this, if you put these in the right fund, both of these can be used in most people's retirement funds. If you build your buckets properly and you build your system properly, Charles Schwab can fit in your income side, and don't let that 3.25 scare you, because that number, the longer you take it, the longer you hold it, the better and better it gets. The Charles Schwab growth engine, this is one You put it in there. It's one of those set and forgets. You'll probably never even think about it down the road because it'll build your growth fund across. So complete retirement portfolios own both. One pays you, one grows you, gives you that balance across the board. So guys, let me know what your thoughts. Leave a comment down below. Hit that like button. It helps the channel the most. Let me know. Do you think Charles Schwab really is doing well? It works well? Where you're at with it? And are you into the growth side of it? I'd love to hear from you. Thanks for watching. And if you're not a subscriber, don't be afraid to hit that subscribe button. And don't forget about the coffee mug, guys, because we're about ready to order our third batch already. So just another dig on that coffee mug. It's surprising how well it's taken off. Guys, thanks a lot for watching. We'll see you next time.